Hi there, it's Walter here from fxjake.com, and I'm just going to look at this idea I've been talking about on the forum of the R. So measuring risk with R. This is a different idea to R in the Pearson product moment correlation. So if you're familiar with statistics, you know what that R is. It's used also in multiple regression and in correlation analysis. That R is basically you're saying how much is one thing, how much is the movement or variability in one thing related to another. So for example, if you have an R of 0.3 between the euro US dollar and the Aussie US dollar, that's saying that you take 0.3, you multiply it by 0.3, you square it, and you get 0.09. So then what that means is that 9% of the movement in the euro US dollar is accounted for by movement on the Aussie US dollar. So that's an old R, but let's talk about a new R here, and that's the risk that we're talking about here, and that's here in this thread right here, R multiple. So the R multiple is something different. It's this idea that which is R multiple equals the total profit or loss for the trade divided by the risk at entry. Now, generally speaking, your risk at entry is going to be your stop loss. So unless somehow you have some stop that moves around, then in that case it would be the risk at the beginning of the trade. But in normal circumstances, most people know what their maximum risk is for a trade, and that's the stop loss. So let's take a look at a chart here. So let me bring up the Aussie. Where is the Aussie? It's right here. Here's the Aussie, and this is the 4-hour chart. Now, what I want to show you here is that there's a kangaroo tail right here. Okay. Oh, whoops. Oh, it's a white arrow. That's the problem. Let me make it blue. Okay. Now, this kangaroo tail right here is nice and long. It's got all the criteria of a normal kangaroo tail. It's inside the previous candle's range here. You can see even the open's at 103.16, and the high of the previous candle is 103.16.7. So, yeah, it's definitely 0.7 pips, 7 pipettes inside of the previous candle. So it is a kangaroo tail. It's where we've seen some recent resistance here and some support back here. So it's a pretty good spot for one. However, where would the logical profit target be for this? Well, the logical profit target, assuming you're going to wait for the market to push through the low of the kangaroo tail, it's going to be right around here at about 45 pips away. Now, the stop loss is going to be about 56 pips away. Now, we could take this trade and assume that the market is going to push through this level, but if we were to do that, what we're saying is we're going to take, 55, 54 pips of risk, or almost actually, yeah, about 55 pips of risk, and we're looking for only about 45 pips of reward. So it's not quite 1-to-1. In other words, if we would go to our handy-dandy formula here, our R multiple, if everything worked out well for this trade, would be like 0.9. In other words, we're making 90 cents for every dollar we're risking on this trade. So it's probably not an ideal setup there. Now let's keep going here. I'm going to hit the F12 key and keep going. You can see that the market would have actually hit our target down here at this zone down there. Clearly would have easily cashed out. But then, look at this. We have another kangaroo tail off the bottom here. Now, how would we play this one? Well, let's look at the R multiple on this one. 102.23 is the stop, and the buy stop's going to be up here at 102.58. So that's about 35 pips of risk. If we're going for our target up here, it's about 65 pips of risk. So it's almost, not quite, but it's almost 2-to-1. It's like 1.9-to-1. So for every dollar we're risking on the entry of this trade, we're looking to make $1.90. Now, it even gets better. That's only if our profit target's right here, which would clearly be an obvious target. But what if we go ahead and target up here at 104.32? Well, in that case, again, we've got about 35 pips of risk, but the reward here is 170 pips. Right, 170 pips. So that's like 4, 5 almost. 5 would be 175. So it's just under 5. It's like 4.92 dollars that we're looking to get for every dollar that we risk. Now, it's a little bit more complicated that when we split our targets and we have a target here and we have a target here, and that's what I'm going to talk about in the next video. But for right now, I just wanted you to understand this idea of this R multiple, which is very simple. But the problem with a lot of traders is they don't look at trades in terms of R multiple. They look at trades in terms of what? They look at in terms of pips or dollars. Well, really it should be, or the account, or even the percent made on the trade, or the percent lost on the trade, when really it should be looked at in terms of a relative reward to risk ratio. And that's essentially what you get when you use the R multiple. So clearly this first kangaroo tail here was not so hot in terms of R multiple, at least for the first target, but this kangaroo tail over here was actually pretty good. And you can see that the market did rocket off, and in fact has gone all the way up to that, well, essentially where we thought the target would be, which is right up there. So that's it for the R multiple, and again in the next video I'm going to talk about what happens when you split up your positions.